Hi, everyone. Judge Andrew Napolitano here for Judging Freedom. Today is Friday, July 7th, 2023. It's 1:30 in the afternoon here on the East Coast of the United States, 10:30 in the morning in Los Angeles, California, from which our next guest joins us. Kevin DeMeritt is the founder and chair of Lear Capital. We're going to have a conversation about economic factors in the United States and around the world. Full disclosure, I am a paid spokesperson for Lear Capital. This is not an infomercial. This is me picking the brain of one of the smartest people I know about the forces and factors that affect our economy, not the least of which is the heavy hand of government. Kevin, always a pleasure. Welcome back to the show, my dear friend.
Yeah, great to be back, Judge.
So this morning, the Department of Labor released, as it does once a month, the new job numbers for the previous month. It showed 209,000 new jobs reported, and the market, of course, went down. Was that a good number? Did the market overreact? Is that something we should be concerned about? Is it a product of inflation?
Well, I don't know if it's a product of inflation. It's a product of what people believe are coming, which is a recession. So the jobs number was much lower than what was anticipated, and the stock market has reacted. And I think it's the first step towards the slowdown in the economy that we've been talking about for the past 6 or 7 months.
Because these traders are always trying to be ahead of everybody else, and they're trying to anticipate. So if the number had been 450,000, the market would be up, but because somebody predicted 300,000 and the true number was 200,000, I'm rounding these numbers off, the traders want to get out of certain positions because they think things are going to go south. Do I have a good understanding of that?
Yeah, you have a good understanding of it. And I really think the market's caught in between a rock and a hard place when you're talking about the stock market. And so is the Fed, quite frankly, because if the number would have been much higher, then the Fed would have had a much tougher time slowing down interest rates, because inflation is probably going to be even worse with the job numbers going higher. When they're coming down, then everybody's worried about a recession. So really the government or the Fed has put themselves into the situation where they printed up all this money and now they have to pay the piper. And I think it's, there's really no way out of this horrible situation. It's either recession or higher inflation.
I think you're right, Kevin. And this is economics 101. The government won't admit this, but the government has created a monster here with the Fed continuing to raise interest rates, with interest rates as high as they are. I mean, I think interest rates should float. I think interest is the rent you pay on money, and it should be negotiable between the borrower and the lender, just like, with the exception of New York City, rent on an apartment is negotiable between the landlord and the tenant. It's the heavy hand of government that messes this up. I mean, how much more is the Fed going to try and regulate interest rates in order to tame inflation when we have relatively good job numbers? I mean, normally 200,000 new jobs in a summer month is not bad. Am I right?
Yeah, no, usually it's not bad, but when the anticipation is more and it comes less, then everybody's going to react to whatever that anticipated number was. And again, they're just caught between this rock and a hard place. So unless they hit the number absolutely perfectly, then everybody's going to start making assumptions on either higher inflation or a slowing economy, one or the other.
So the Fed blames inflation on you. The Fed blames inflation on hardworking entrepreneurs who built their businesses, who pay their employees well, who pay themselves well, who invest that money, which helps other people in the locations where the money is invested. And then they call us all greedy and say we are the cause of inflation. What is the real cause of inflation? It's not the Kevin DeMeritts of the world. You've created wealth. You haven't caused prices to go up.
That's right. When you print money, and the definition of inflation is too much money chasing too few goods. So if we just look back to 2008, when we had the Great Recession, we were $8 trillion in debt as a country. We're $33 trillion in debt today. That's 25 extra trillion dollars over a 15-year time period. It's $1.5 trillion per year. Too much money chasing too few goods does not come from us. We do not have a printing machine in our garage that we can go and print some money and go, give it out to everybody free, like we saw in the pandemic. So the government has created this, and now they need to fix it, just like they needed to fix it back in the 70s. Inflation is very difficult to put back in the bottle, and I think they're going to take the next 2 to 3 years to get it down to their 2.5%.
How risky is it for the government to add 25 trillion in 15 years? And since the debt bill was passed, which for the first time in history has no numerical cap on it, Janet Yellen's in China. We'll talk about that in a few minutes. She could be borrowing all the money she wants from the Chinese government, but she has borrowed since May $2 trillion. I mean, that is inconceivable. But how dangerous is it for the government to add $2 trillion into the money supply in such a short period of time?
Well, you're going to get some reactions. You're going to get reactions in the interest rates, and that's what we've seen. So to give you some sort of an idea of how dangerous that is as a country, the U.S. government at $33 trillion, if you add 1% interest to that $33 trillion, that is $330 billion per year for every 1% increase in interest rates. Not only that, on the personal side, there's $17 trillion in debt from people like you and I. You add 1% interest to that, it's $170 billion. Add just those two together, and we're not even talking about corporate America here. That's $500 billion, $500 billion a year when they raise interest rates just 1%. That's costing the American people, on top of the fact that our medical bills are more, our food costs are more, our energy costs are more, everything costs more. It's extremely dangerous, especially for retired people who have 2/3 of the wealth in the United States.
What interest rate does the government pay now? If I wanted to loan the government money, what interest rate would I be looking at? I guess it would depend on how much of a bond I wanted to buy. But with the government raising interest rates on everything else, it's obviously causing itself to pay higher interest for the money it has to borrow. She didn't get that $2 trillion for free.
That's right. Yeah, it used to be in the 2.5%, 3% range. Now it's around the 5% range. And as those notes come due, the 1 year, 5 year, 10-year notes that are rolling over,
right,
it's just going to cost the government more and more and more. What the government should have done when interest rates were extremely low is went and put everything into a 30-year note, but they didn't. They wanted the lowest rate, so they went with 1 year, 2 year, 5 year, 10-year notes, which are going to roll over much more quickly at that new higher interest rate and cost every taxpayers a much higher amount. And it will be in higher taxes later on, in my opinion.
So this kind of debt, which will be 35 trillion before the end of Joe Biden's term, at 3 or 4% interest, you're talking about $1 trillion. Correct me if I'm wrong. You're the numbers guy. $1 trillion in debt service. That's money collected from the IRS, whoosh, goes right out to pay the debt service.
That's correct. As much as they've raised interest rates, if you rolled over most of that debt, you'd be at near $1 trillion in extra money needed just for the servicing of the debt in the United States. And I'm telling you, the last time this happened in the 70s, they raised taxes, and they're going to be on their way to raise taxes again because they cannot service that kind of debt with everything else they have in the economy without raising taxes.
Only the government borrows money to pay interest on borrowed money. Your bank wouldn't let you do that unless you're going to lower the rate. But to borrow money and pay interest on borrowed money is insane. I always like this example. You and I talked about this at lunch not too long ago when I was out in Los Angeles. The federal government, Woodrow Wilson, one of the worst presidents in American history for a variety of reasons. The Judging Freedom audience is familiar with my opinions on and diatribes about President Wilson. But he borrowed $30 billion with a B dollars to fund World War I. we are still paying interest on that debt. It has just been rolled over. It hasn't been retired. So the principal debt of 30 billion is still out there. It's owned by different entities than those who loaned the money to the government at the time of World War I. How much interest has been paid on that 30 billion? 15 billion. Only the government pays effectively a 50% interest rate because it won't retire the debt. It just keeps it out there. And it's not just Democrats. Remember Dick Cheney, debt is a good thing.
Yeah, debt does not create wealth. We all know that, right? I can only go spend my credit card and feel good about it and go to the bank and get a loan on my house for so long, and pretty soon I need to pay it back or pay higher and higher interest rates like we see now. So we are not going to be a wealthier country because of all of this debt. It just feels good in the short term.
What is the status of gold and silver now? How much is it in demand? What is it selling for? How does it help you secure against the future?
Well, a lot of good questions there. First of all, demand is through the roof for both of the metals, gold and silver. Right now, you have a 50-year high from demand from central banks around the world in precious metals. We haven't seen this kind of demand from central banks purchasing gold since the mid-1970s, when we had inflation and a bunch of money printing back then. But it makes sense. Hey, if I could go into my garage and print up a bunch of paper money and go buy a physical asset like gold, I would do it too. That's exactly what they're doing, because they know every time, Judge, that they print that paper money, the paper money that's already existing out there becomes worth less and less, and tangible assets like gold and silver become worth more. So they're coming into the market. They're not speculators. They're not day traders. When they purchase, they hold that metal for 5, 10, 15 years at a time. So the demand continues this year from central banks on the gold side. As far as silver is concerned, I think it's just absolutely on sale. It trades about half of what it had in 2008. And solar demand in 2014 was around 5-6%. It's around 15% today, and it's going to increase by about 7% per year. Just more and more silver continues to get sucked out of the market from solar demand. And if we have another recession or another correction in the market, we both know that gold and silver have already performed extremely well. And I think silver is going to be your best bet over the next 9 to 12 months, in my personal opinion.
This may sound like economics 101 or maybe even baby economics, but as more gold and silver is discovered or mined out of the earth, does that reduce the value of the gold and silver people have purchased for their nest eggs?
Well, that's a great idea. You cannot pull the amount of gold out of the ground that we're printing paper dollars at. So the amount of gold pulled out of the ground has been very, very consistent over the past 30 years. Even with better technology, you have to go deeper and deeper into the ground to get more gold. So we're still pulling out about the same amount of gold we were 10 or 15 years ago, around 2,500 metric tons per year. But the paper money and the debt has gone through the roof. So if you put an increase in demand from paper money on a fixed supply, which is basically, gold coming out of the ground and what we have available, that's why you're always going to see an increase in that kind of a tangible asset. It's very similar to real estate. I can't build any more real estate. So if they keep printing up money, real estate over the long term should get more and more expensive. On the silver side, what I told you was this solar demand alone is increasing by 7% a year, but production on silver is only increasing by 2% a year. By 2050, they estimate that solar demand will eat up about 85 to 90% of the available silver supply. We can't pull it out of the ground any faster than we're going right now. And that's, like I said, been the same production limits for the last 30 years.
There was a time in America when contracts, history from your studies and from your work, contracts had gold clauses in them. So the seller would require the buyer to purchase the product in gold. Of course, we don't have these clauses anymore. I ask you this because, people are commenting to me on the basis of what you and I are discussing. and somebody says, gold's a great idea, but I can't carry it in my pocket. So it makes me think this question: do you know of people who pay their debts in gold or silver? And can you do that?
Well, we just had a few states saying that you could pay your taxes in gold and silver, Texas being one of them. So they're making laws that say gold and silver could be used as currency. Gold and silver is currency. It's been currency for 5,000 years. I can't carry a piece of real estate around in my pocket to pay for something either, but I can plant something on it. I can use it for, going down to the bank and getting a loan. I can sell it at any point. I can live in it. I mean, different types of assets that I can't carry around in my pocket still have value.
Does the silver dollar still exist?
No, the silver dollar in 1974, the government took us off the gold standard completely. And as soon as that happened, the price of gold and silver went through the roof, and money printing, no one looked back. It's never been more prevalent than it is today, and started in 1974. So those dollars that were backed by silver, and the $20 dollar bill that was backed by $20 in gold no longer exist at all.
But the coin, the dollar coin, that exists, even though you can see I have some ink on my hands there. Sorry. That exists, but it's not made of silver.
Correct. That Morgan dollar or peace dollar that we used to see if you went to Vegas and played the games, they used to have those silver dollars. I mean, that isn't worth $1 anymore. It's worth, it's an older coin. So in the worst case scenario, it's worth about $27, $28. And in the best case scenario, in high quality conditions, it could be worth $300 or $400. A $20 gold piece, which is basically 1 ounce of gold from the 1920s, they keep saying it could buy a man's suit. Well, it could buy 3 or 4 men's suit today. It's worth a couple of $1,000s, depending on the kind of suit you wanted. So it has held its value, which is exactly what I'm talking about. That was worth $20 back in 1929. It's worth a couple of $1,000s today. It's kept up or exceeded the rate of inflation and the money printing and the devaluation in the currency that we see each and every year that they print up paper money.
Okay, switching gears. As we speak, the Treasury Secretary, Janet Yellen, she who just added $2 trillion to the government's debt, is in China. What should she be asking for or talking about in China?
Well, that's a great question. I don't know what she's going to be talking about over in China. Probably going to be asking for more money because somebody needs to support
she is not there. She is not there in order to open up the channels of trade. She is there, hat in hand, saying, buy some of our bonds. Give me $1 trillion and I'll give you a note and pay you 3% interest on it.
Well, yeah, probably pay more than that. But that's what she's there for. Hey, look, don't sell off your $1 trillion plus of U.S. reserves because we need your money to support our economy. You cannot print up $25 trillion in 15 years without somebody supporting it. And they're happy to support it because they know if they're holding that debt, they hold a big sledgehammer over our heads.
Last area I want to ask you about, the effect of President Biden's sanctions on Russia. I'm of the view, and of course, you know me, I'm a legal guy, not an economics guy. I have a pretty good understanding of economics 101. I'm of the view that these sanctions have not hurt the Russian economy and actually have hurt the West by shutting off the channels of trade that existed. There is still $10 million worth of Russian vodka sitting at Port Newark. It arrived the day the sanctions were imposed. They can't send it back and they can't distribute it.
Right. Yeah. So think of what we started talking about. Too much money chasing too few goods is inflation. If you take less goods out, we're talking oil here just for a minute, then oil prices are going to be higher because you've sanctioned them. Now, is there a good reason for the sanction? That's up to everybody's opinion. But from an economic standpoint, doesn't make a lot of sense because you're going to drive prices up higher in an inflationary environment. So people are going to pay more for wheat, for the things that come from China and Russia, when we sanction them, are going to be more expensive here in the United States.
Kevin, it's a pleasure to chat with you, my dear friend. We'll do it again soon. My only request is that I'm not supposed to say this, but I'm going to say it anyway. Tell Dina I love her.
I will. I will. She loves you too. Thanks.
All the best. Thank you.
You
Thank you very much for joining us. We'll see you again soon. My friends, my interview with RFK Jr. will be posted on our website, on our YouTube site at 6 o'clock Eastern today. It's a dynamite interview of Bobby Kennedy at his most candid self. Scott Ritter at 2:30 this afternoon. More as we get it. Judge Napolitano for Judging Freedom.